We're delighted that everyone is here, and we have a terrific panel to discuss with you the road ahead, which is, I'm sure, on everyone's mind at the moment, particularly what we've been through over the last 2 or 3 years. Before I get started, it's important to note that none of what we say here tonight, although we're talking generally about a lot of investment themes, this is a law firm-related investment company after all. The most important decision you make as an investor is how much risk to take. And that's something that will affect how you incorporate any of the ideas that you hear tonight or any other investment ideas for that matter. With that being said, I think it's actually particularly appropriate that we're here in a museum of contemporary art to discuss investments. Because the job of an investor is very much like the job of an art curator. You have to decide what's going to be a durable theme, what's going to be an idea that has longevity. And obviously what you're seeing now, as you all know, is one of the most important works of art of the 20th century, Marcel Duchamp's fountain sculpture, which is what he called a ready-made, a urinal that he signed and then exhibited. Just lest you doubt the importance of this, the original has actually been lost. 8 copies were made. Those copies are now in the Tate Modern, some of the Pompidou Center, some of the most important museums of the world. And the one copy that was available for auction was sold by Sotheby's for $1.7 million, a copy of a signed urinal in 1999. So we're all going to be talking about the rationality of investment markets. It turns out that the average investor and many professional investors aren't actually terribly good at predicting what's going to happen next. This is some work that was done by the Economist magazine that showed on average investment funds which are in the worst possible sector tend to attract double the money as investment funds which turn out over 12 months to be in the best possible sector. So the average investor typically buys high and sells low. Often they're motivated by the 4 most expensive words in investing, which are just as dangerous at the bottom of the market as they are at the top. And we don't always have a clear warning that we are at the top of the market, although the Pets.com sock puppet was a pretty good warning in 1999. Eventually, however, Stein's law comes into play, which has, like a great piece of modern art, is both deeply profound and totally obvious. If something cannot go on forever, it will stop. And we saw it stop in 2008 with the financial crisis that we've all just lived through. It was one of those rare moments when actually the long-term returns of stocks fell below that of bonds, and indeed the 10-year return of equities went negative throughout that period. So one of the 3 worst years for equities in history. Quite a black swan type of event. So with that as a preamble, I've asked our panelists to begin the conversation by talking about a key fact that they think should be on the minds of investors as we go forward. I'd like to briefly give you 3 key facts of my own. The first is just about the way the world looks today. This is a graph of global population. The developed world is the United States, Europe, Japan, Australia, New Zealand, all of what we call the modern economies. That's 16% of humanity. 20% of the world lives in China, 17% in India, and the rest in what we broadly call the emerging economies. About 90% of the world's investment markets are concentrated here, and about 2/3 of world GDP is concentrated in the developed markets. China has been growing its economy very rapidly. Those of you who were at our event about China's number 2 know that China is now the world's 2nd largest economy, having recently surpassed Japan, and is on a very rapid growth rate. China does have a number of problems, however. These pictures were taken by my colleague Lauren Zhang on a recent trip home to China, and they illustrate the importance of entrepreneurialism in Chinese society. China essentially has centrally planned capitalism, and there are a lot of questions about the sustainability of that, as well as the challenges of urbanization in China. This is a picture that I took in India about a month ago. And as you can see, the electrical grid is not centrally planned. Very, very entrepreneurial, very energetic, but with its own issues as well. So fact number one, the rise of these developed and emerging economies that were on the periphery and are not as much anymore. Fact number two is simply the vast scale of indebtedness of those developed economies. The United States yesterday hit its $14.3 trillion debt ceiling. This is going to be a major political topic in the years ahead, or in the months ahead, excuse me. And as John Maynard Keynes, one of the most important economists of the 20th century, observed, another profound and perhaps obvious statement, a debtor nation does not love its creditor. And there's a long history of debtor nations not loving their creditors and doing sneaky things to either explicitly default on their debts or erode their value over time. This was pioneered, at least the first recorded instance of this we have is perhaps unsurprisingly from Greece. Dionysius of Syracuse got into trouble issuing promissory notes to his citizens. He issued an edict that they were to give him all of their coinage on penalty of death. He stamped the 1 drachma coins as 2 drachma coins, reissued them, and paid off all his debts. Henry VIII was a bit more subtle. He's better known for his behavior with women, which would probably qualify him to run the IMF. But he embarked on a campaign of debasement of the British pound sterling, during which the British pound lost 83% of its silver content. This is a term that you're going to hear more and more, if you haven't already, this idea of financial repression, the idea of governments managing down their high debts over time. There's been some excellent research recently on this, and it typically involves a number of more subtle types of capital controls, which are even more effective when compounded with a bit of inflation. So fact number two, the great indebtedness, particularly of the developed economies. Fact number three, finally, is the massive monetary intervention that we've seen, particularly by the US Federal Reserve. This is a graph of more than 50 years of monetary policy history, the balance sheet of the Federal Reserve. You can see it growing in sort of a smooth manner up until the financial crisis, when suddenly it has doubled. This can be a massively inflationary policy, but there's not a lot of worry about that right now because deflation is a greater concern, and also because the Fed has a dual mandate to manage both inflation as well as unemployment. And right now, unemployment is at near post-war highs and is a terribly entrenched problem. It's not just a problem for the Fed, it's a political problem as well. No president has been re-elected since World War II with an unemployment rate above 7.5%. While we in the developed economies have been worried about unemployment, inflation has been affecting a lot of these emerging economies. This is a photograph of the protests in Egypt, and there's a couple things I would note about this. Number one is, look at the crowd. These are not rabble. These are middle-class people out protesting. And the second is this woman's sign. The first word on it is bread. And then comes freedom, and then comes social justice. And so increasing prices were actually one of the key factors that led to this revolt in Egypt and elsewhere. Finally, I'll come back to China for a moment. China has a little over $1 trillion in US Treasuries at the moment. They're very concerned, I think rightfully so, about the erosion of value in those treasuries. This is a photograph of China's first aircraft carrier, the Shilong, which is named after a Chinese admiral who conquered Taiwan in 1681. Very subtle. It was originally purchased from the Ukraine in 1998. They said it was going to become a floating casino off of Macau. It's not. Finally, my last slide, I'll leave you with one further thought, since we are in an art museum. This is a graph of the performance of Sotheby's, which is a public company. As I mentioned, they're the ones who auctioned off a copy of Fountain back in 1999. And you can see that their share price is actually remarkably coincident with past bubbles. Here we have the Japanese bubble, then we have the internet bubble, here's our sock puppet again, the housing bubble, and here's where we are today. And so with that, I'd like to turn to our distinguished panel, starting with Peter Perkins. I have to be honest, I was a little bit ambivalent about inviting Peter to come speak with us today. He is a fantastic economist. He was managing editor at BCA, which is a terrific, globally known economics firm up until last year when he left to co-found Macro Research Board with some other partners. We very much value our interactions with Peter and view him as a bit of a secret weapon. So my ambivalence was more about having this firm more widely known and eroding our comparative advantage. But Peter, this is your slide, and thank you very much for joining us today.
Okay, well, I obviously, with that introduction, I will surely correct any ill-informed opinion people have, but I also will say it's pretty good to know that a lawyer can stand up at the very beginning and say, put out a disclaimer that says anything I may say cannot be held against me. Well, of course, in the investment industry, that we live with that every day, right? Whatever we say, if it's right, if I'm right, obviously, I take all credit for it. If we're wrong, then it was the wayward elements of the market. What I've put up here is a couple of things. First off, let me just start by, because this chart is as simple as it is slightly complicated. The idea here, people right now, and particularly in the last 6 or 8 weeks, have become increasingly concerned again about the health and vitality of the U.S. economic recovery. I'm an American, I travel a lot worldwide and so forth, and I often have to say, I hate to say this, folks, but the reality is I'm the most important person in the world. And that is because if I spend money, or if you spend money, the global economy tends, other things being equal, to hum along. And if we don't, it doesn't hum along. And there's a lot of uncertainty about whether or not the global economy is going to hum along, whether the U.S. is going to hum along. I think, there's a lot to be worried about. There's a lot of structural issues and so forth. The cyclical dynamics are pretty important, and that's what this chart is going to refer to. The other thing that I think is important is when people look out and say, I don't really know what to invest in. I was burned twice in the past 10 years by equities, right? 2 of the biggest equity market crashes we've seen in the last 70 years occurred in the last 10 years. And people are naturally hesitant to re-embrace an asset class that has suffered such calamitous downturns. And whatever academics may say and whatever your advisors say, whatever, they probably didn't tell you that was the outlook that was coming, right? So it's natural for people to be quite cautious. But what I want to point out here is this is a 35-year chart of a profile that tells us something about corporate profits. And at the end of the day, you're not in the long run, you're investing in the economy. But in the short run, you're really investing in the health and vitality of the corporate sector rather than of the economy as a whole. And what this shows is, so return on equity is the profits as a share of the shareholder equity that the company has, right? And it tends to cycle around. And what you can notice is in the early 1990s, we had a very deep downturn in corporate profits. We sprang back. Partly it was held back in the late 1990s by weak earnings in Japan. We had another sharp downturn in 2000 and 2001 following the tech bubble. And then, we had the sharpest downturn in corporate profits in 2008 that we've seen since the Great Depression. And it was a universal phenomenon. But you can see we've had quite a sharp snapback in corporate profitability. The return on equity has risen back to its long-term historical mean. People recognize, or people tend to think, this has been an economic recovery that has been disappointing in its strength. And it has been. If you're unemployed in Ohio working in an assembly job, it's been very disappointing. But if you have been a corporate shareholder, the recovery in profits has been anything but subpar. It's been very strong. And that's really what we're trying to focus on. If you're an equity investor or an investor more generally, it's the health of the corporate sector that is the driving force behind how equities are going to do. And they've been doing pretty well. A couple of further things. You can see there's shading. It's a bit complicated, but the shades are for when the U.S. has a recession. Profits tend to do well as long as the economy is recovering. Right now, we see nothing that says corporate profits are about to stumble. The corporate sector earning money overseas in emerging markets, supported by a cheap dollar, admittedly, but this is happening globally. Low wages are keeping corporate profits very strong, and that doesn't look like it's likely to change anytime soon. The corporate sector's in pretty good health. And I think investors tend to underestimate the importance of corporate profits in their decision to make or buy equities, and instead emphasize too much the economy. And in this particular circumstance, the gap between what's going on in the economy and what's going on in the corporate sector is quite significant. This thing leads me to conclude that, for whatever cautiousness many people may have, they haven't embraced equities. The cyclical circumstances, the next 12 to 18 months, the outlook for corporate profits remains pretty healthy, and the outlook for equities remains reasonably good. Investors have not committed enough capital to equities. If you believe in the sustainability of the U.S. economic recovery, this is a trend that supports increasing your allocations to equities. Okay?
Thank you very much, Peter. Our next panelist, Sandeep Bhagat, is head of equities at Vanguard. Prior to this, he was the head of asset allocation at Morgan Stanley. He has more than 2 decades as an investor. He received his undergraduate degree in chemical engineering from the University of Bombay and a master's degree from the University of Connecticut. So thank you very much for joining us, Sandeep.
Thank you. Before I take a look ahead at the equity markets over the longer time period, I want to focus on the present and the current moment and just add a little bit to what Peter observed in the context of the current economy and the current outlook for equities. As you look around, you cannot but help fight the sensation that you are looking at a rerun of some sort. It's almost like we have seen this movie before, and a bad one at that, playing out in the equity markets, because just about a year ago, at about this time, there was weakness in the equity markets to the tune of more than a 15% decline, triggered by influences that still persist around us. So we were fighting rising inflation, global tightening, and what now seems to be the perennial Eurozone sovereign debt crisis. If anything, a few other things have been added to the mix. For example, unrest in the Middle East and North Africa, and possible supply chain disruptions from the disaster in Japan. And yet, the equity markets seem to be chugging along, perhaps going sideways for a bit here, climbing one wall of worry after another, and coming across as very resilient to all of these distractions. And the reason for that, so let me pick up on a theme that Peter put on the table and add a couple more observations. The difference between a year ago and today is the fact that the economy is on a more solid footing because we have continued to add jobs in the meantime. So the conversation a year ago was about the prospect of a double-dip recession. You don't seem to hear that all that much in this go-around. Peter talked about the improvement in corporate profits. So for the quarter that just ended, companies are likely to report, when the tally is all said and done, an 18% growth in profits on a year-over-year basis. The more important implication for the economy looking ahead, and also for the stock market, is on a lagged basis, what follows growth in corporate profits is a pickup in business investment or capital expenditures. So that if you're looking for catalysts for the US economy beyond this current soft patch, you might have that as a possible tailwind. And finally, which brings me to the theme that I want to emphasize, benefiting the equity markets at the moment and for a sustained period ahead is the fact that valuations are fairly reasonable. What do we mean by valuations? So however you think of the price to earnings ratio, on a trailing 12-month basis, the PE for the equity market is about 15 times. Forward earnings is 13.5. If you look at smoothed earnings over 5 or 10 years, the market appears to be reasonably valued. And that is the key difference for the decade that lies ahead of us for equities compared to the decade that we just suffered through, the so-called lost decade for equities. Which brings me to my present chart here. That decade was lost even before it began because we started the decade at lofty valuations. The relationship we are highlighting here is realized returns in the equity market over a long period of time on a forward-looking basis are critically dependent on your starting valuation levels. And there is an inverse relationship. That's why you see the line pointing south from left to right. High starting valuations lead to lower future returns. lower valuations lead to higher returns. And because we seem to be fairly valued at this point, in all likelihood, the upcoming decade for equities, to complete my comments on a constructive note, seems to offer a fair degree of hope. We are fairly valued at the moment, and so what was a headwind for the last decade, what was a decrement to equity returns, doesn't appear to manifest itself looking ahead, and therefore equities should perform in line with the dividends that they pay out and the earnings growth that they normally produce. And perhaps even more heartening is that in terms of what you expect stocks to do compared to bonds and cash, it should be business as usual in that stocks appear likely to outperform bonds and cash, much like you would expect to get compensated for bearing the risk of investing in equities. So that's my one key observation about the equity markets looking ahead, and I'll turn it over to Sean.
Thank you very much, Sandeep. Sean McLaughlin is with us from Cambridge Associates. Cambridge Associates is one of the world's leading investment consulting firms. Their clients include some of the largest pensions and endowments, as well as governments and other major investors. Sean is at the Arlington, Virginia office, where he's a managing director, and he specializes in writing about investment themes for Cambridge's clients. So Sean, thank you very much. I'll put your slide up.
All right, thanks, Todd. So if you thought these gentlemen's slides were complicated, just wait. This is just the first half, actually. It gets worse. So I'm actually going to talk about an asset class that is despised is probably too strong of a word, but certainly not loved, and that's municipal bonds, and particularly the long maturity municipal bonds, which have traditionally been pretty sleepy, and over the last 6 months been significantly less sleepy. And I just wanted to talk a little bit about why that is so, and what's the upshot for investors. Let me see if I can get this laser pointer to work. Yeah, okay. So. Just a couple of things that I would point out in the municipal bond space that have occurred over the past, we'll call it 6-7 months, that have been very detrimental to long maturity municipal bonds. And we're talking about municipal bonds issued by states, cities, other organizations like that are generally free from income tax when you get the coupons. And here we're talking about bonds that are like 20, 25, 30 years before they mature. So the graph shows treasury bonds, long treasury bonds, 30-year treasury bonds on the bottom in the red, and then above that is the yield of the long muni bond sector. So over this time period, if you look, those two bullet points at the bottom, Bernanke and the FOMC, those indicate basically when the Federal Reserve Bank first outlined and then later basically implemented quantitative easing 2. The QE2 is something that I'm sure you've all seen in the news, and that is the purchase of $600 billion worth of treasury bonds starting in November of last year and continuing through the end of next month. It's actually been more than $600 billion because they're also reinvesting proceeds of earlier investments that they've made. But they're buying in the neighborhood of 70% of treasury bond issuance over that time period. So massive influence in the bond market. And there was concern on the part of investors that this would distort things, and also that those assets eventually that are being printed in order to buy the bonds will eventually work their way into the markets and could have an inflationary impact. And so the treasury yield curve, which is basically the yields of treasury bonds from T-bills that mature in 3 months to treasury bonds that mature 30 years from now, that steepened because of concerns that over the long term this could have an inflationary impact. That hit municipal bonds right in this time period because they sold off in sympathy with treasuries. After that, you started having significant credit concerns coming into the marketplace as well. People are worried about the creditworthiness of municipal bond issuers. Municipal bonds, municipalities, their finances tend to lag the finances of individuals and of corporations. And it's for all sorts of structural reasons that I won't get into here because we just have a couple of minutes. The bottom line, though, is that while many of you and perhaps the businesses that you're involved with, some of the companies that you own, as Peter mentioned, the profitability of of those companies has increased. Your personal finances may feel, maybe on better track than they were 2 years ago, 3 years ago. Municipalities are just now troughing in terms of their revenues, and they've just started to get back on the uptick. But there are significant credit concerns in municipalities, and they got a lot of attention right around here. And the top bullet there, the 12, 19, 2010, does anyone recall watching that television program? I don't know if you can even see it here. The type is pretty small, but Meredith Whitney, who's a bank analyst and had basically made her name making some good calls on the banking sector, has switched over and is now trying to start a ratings agency to rate municipal bonds. And she was on 60 Minutes. It was actually the third highest rated program that week in all of television in the United States, talking about the fragile health of municipalities. And she made some excellent points, but she stated a few facts stated a few predictions in terms of defaults that stretch credibility. And that said, they got a tremendous amount of attention, and they got it at a time when the municipal bond market was already under a lot of stress, because one of the biggest outlets for municipal bond issuers over the past year and a half has been what's called the Build America Bonds program, the BAB program. Let's see if I can find it here. Where is it?
Right there.
Yep. And that was a program that was basically invented during the recession to take the load off the municipal bond market because of a different program called TOBs, which is basically leveraged purchase of municipal bonds by hedge funds, that blew up in 2008. So to get the pressure off the municipal bond market, they invented the BAB program. It's been fabulously successful. I think a lot of market participants expected that to be grandfathered out, and to die a slow death, if you will. Instead, we found out in the end of December that it was basically going to end at year end. And so you saw this confluence of events. At the same time, if you could advance the slides, Todd, individual investors saw this turmoil in the bond market, and they saw Meredith Whitney on 60 Minutes, and they saw the turmoil in the Treasury market, and they said, I don't need this. I've got plenty of other things to worry about in my life, and so I'm going to go ahead and sell my municipal bonds. And they did it. And this is outflows from municipal bond mutual funds. Individual investors control the municipal bond market. They're not the only investors. Insurance companies and other buyers also own muni bonds, but all of you and other individual investors are by and large, the controlling force in the market. And investors got very skittish. And as you can see, this, if you look here on the far right, this is the net outflows. So basically, how much money is going in, take away how much money is going out. That net amount is massively negative, much more than in any other period during the history of municipal bond mutual funds going back over the last 20 years. And this is a pretty illiquid market. It already had all these structural issues going on, the credit concerns, and then you couple with that the fact that investors are taking $35 billion out of their municipal bond mutual funds. The managers then have to start selling bonds into a market that has no buyers. That's what caused yields to just skyrocket in December and in January and February. And at one point, actually, here's the bullet for it, the AAA, so the highest rated, highest quality municipalities, 30-year bonds, so like state of Virginia, for example, actually hit 5%. Now, once it hit that level, it started to bring buyers back into the market, and people said, maybe we should take a second look at this. The outflows are still negative in the mutual funds, but they're much less negative. So it's like a few $100 million a week instead of several $billion a week versus of outflows. Part of the reason why we've seen some stability and the market is firming up a little bit, and you can see the yields have come down over the past couple of months. Part of the reason for that is that the issuers of municipal bonds got spooked by this, and they said, "Whoa, we're not going to issue into this market and pay a fortune on interest costs." So they said, let's hold off. Let's hold off on our projects. Let's refinance later. And so the municipal bond supply so far this year has been basically only half of what it was last year. So that has helped, well, cure is probably a strong word, but that has helped potentially postpone what could be more pain down the road. We believe that municipal bonds, long maturity municipal bonds, are reasonably attractive even at current levels, but there is certainly the possibility, though, over the next year that you'll see yields come back up very substantially, because it's unlikely that issuers will be able to hold off on supply forever. And so if that supply comes back in, unless the credit woes stop getting the attention that they are currently, you could again see yields spike. And when they do, we think that's a very interesting opportunity for bonds that, in our view, frankly, many of them are quite safe, quite good credits, and the tax advantages are very substantial. So,
Thanks very much, Sean. So we've heard a perspective on both the equity markets as well as on the bond market. As we look for the next potential black swan or bursting of a bubble, I think many are looking at the bond markets, either in Europe or factoring in the unfunded entitlement programs or state and local debt as compounding America's debt problems. Let's focus on Europe for a moment. I'd like to ask the panel to comment on specifically seems, as Sandeep said, the perennial issue with European debt and how you see that unfolding. And Peter, could you start us off?
Sure. Well, the problem in Europe is, I think we have to be quite careful about the underlying problem in Europe, because what really is at root here is that, Greece has liabilities that are denominated in euros, and it has no control, its economy is in a very, very deep recession, and it's being forced to undertake austerity. Greece, what's happening to Greece is the same thing that happened to Argentina in the middle of the 1980s and happened to Indonesia in the 1990s. It's an unfortunate consequence. I'm a firm believer, you cannot tighten your belt to prosperity. And that's the way that Europe is approaching this process. Ultimately, this is an existential issue for Europe. Whether Greece, I wouldn't buy Greek debt. It's a highly, highly speculative proposition. But more importantly, Greece is insolvent, right? Its economy is uncompetitive. Greece is insolvent. But it's a more existential issue for Europe, because we have a family member who has gone completely wayward, and mom and dad are not trying to get them to improve their behavior. Mom and dad just took a steel-toed boot and kicked them right in the teeth, and now we're trying to figure out, whether that's going to make the wayward child behave better. You have to be fair, do not touch Greek debt would be my argument. Spanish debt might be a little bit more interesting, because at root, Portugal's not big enough to matter. Greece is not big enough to matter. Spain is big enough to matter. And if you jettison, or if you risk jettisoning Spain from the European Monetary Union, you will have undermined basically the economic entity itself. I would just like to remind people, I go to Europe all the time. I find it funny that an American has to remind Europeans sometimes. The whole exercise of the European Monetary Union was effectively to ensure that Europe would not undergo a war between the states after the First and Second World War. It's been a 50-year proposition. It's been a reasonably successful proposition. Europeans used to struggle because, you lived in Luxembourg and you walked across to France or to Germany, you're surrounded by both of them, and you needed 3 different currencies in order to operate. It was a highly inefficient thing. But, solving debt problems like this is extremely difficult. It's very different from the United States. It's not the same as California has a debt problem and Greece has a debt problem, because Californians, we all construe Californians as Americans, just like Massachusetts people are Americans. But Finns don't view Greeks as Finns. They view them as different people, and it's a much more problematic thing. I think this is going to take us years to resolve. It's going to be a very, very dirty thing. Today, people are bearish about the dollar and bullish about the euro. Tomorrow, we could see that flip around substantially, because the euro is fraught with many of the same types of problems the U.S. is, and it's going to be very, very difficult to resolve them.
Okay. the European Union seems poised to be able to deal with the pig part of the problem here, Portugal, Ireland, and Greece. Spain would be, is indeed too big to fail. That would have dire consequences. In addition to everything Peter said, I would make the following observations, that some degree of Greek debt restructuring has already been priced into the markets. If you look at the spreads associated with the prospect of a default of Greek debt, those have skyrocketed. If you look at the impact on European financial institutions that are most likely the proud owners of these bonds, their risk has been reassessed and has been repriced. It's just a matter of time. On this topic, I would just highlight the possibility that herein could lie the beginning of another potential crisis if the contagion spreads to other parts of the globe. So if this problem doesn't remain contained within Europe, and we saw how financial institutions are all so intricately interlinked, there could be implications for US financial institutions and Asian financial institutions.
Now, Sandeep, Peter has remarked that Americans being still at the center of the financial universe, it's our spending that matters, and Europe is more of the caboose. But you do see the prospect of if the European debt crisis escalates, that could be a...
Yeah, and the mechanism would be contagion transmitted through the financial system, because this is how the crisis would unfold. As soon as that debt is restructured or repriced, it immediately results in a loss to the owner of those bonds, which affects their balance sheet and their income statement. And depending on who is counterparty to whom in what transaction, one institution's losses could get transmitted to somebody else. And so just keep an eye out for that. I think the markets might actually be sanguine if you look at how risk is being assessed in US banks and Asian banks. The so-called CDS spreads have not gone up for these institutions. They have been repriced for European institutions.
And meanwhile, US debt, if you incorporate unfunded future liabilities, if you incorporate state and local debt, we start to look rather Greek ourselves, and yet the 10-year Treasury yield is just a little bit north of 3%. How do you account for that disparity?
Well, I think the two central banks have conducted themselves differently. The ECB is focused, the European Central Bank, on a singular objective, which is price stability and to ward off inflation. And with that singular objective, it has begun the tightening process. But given all the austerity measures that are being put in place, monetary tightening along with fiscal discipline and repression could just be a recipe for very sluggish growth in the Eurozone. And keep in mind, Peter, on your observation on the currency, the euro seems to be a step ahead because their tightening has begun while the Fed is still stimulative, the Fed managing to the dual objective of both fighting inflation but also seeking stable growth and full employment. There is kind of this asynchronous timing of the movement in short-term interest rates, but that could well revert with implications for the currency as well.
So Sean, you highlighted municipal bonds, which at least some have highlighted as another potential time bomb that's out there. What other time bombs or key concerns would you highlight for the audience?
Well, I mean, certainly the European debt crisis is something that we're concerned about. And like Peter, I guess I wouldn't probably would be cautious about buying Greek bonds with my babysitting money, even yielding 24% or whatever they are. But at the same time, I wouldn't necessarily hesitate to buy European multinational companies. These big platform companies, the Nestle's of the world, the Unilevers, the Heinekens, they have very diverse revenue bases. In some ways, many of these multinational companies in Europe and as well as in the U.S. Offer an entree into the emerging markets, but they offer it at much lower prices, or at least in some cases more reasonable prices. So one thing I would say about the European debt crisis is don't let it necessarily taint your view of all things European from an investment perspective, because the equities the multinationals, I think, could still prosper.
Well, and back to Sandeep's point, the valuations of European companies are even more attractive in some cases than the US companies.
Yes, I agree.
In which conversation probably lies a message that don't get too focused on growth, economic growth. People talk about a new normal surrounding us. There might be a new normal for economies in that growth could be sluggish because we have structural headwinds in the form of high unemployment, high debt, high deficits. But what affects the capital markets are prices and valuation. Valuations have corrected to reflect all of these problems and possibly lower growth. And so we keep coming back to that theme that while there might be a new normal on the economic front, it's probably not likely to be seen in the capital markets.
Well, one asset class that's appreciated tremendously recently has been commodities. And I wanted to turn to the panel to discuss commodity price appreciation and its implications. One explanation is the tremendous demand that we've seen from the emerging markets. Peter, you've written recently about commodity prices. Could you maybe start us off on this?
You know, I came to this startling realization very recently that China's got 1.3 billion people, and you know they're going to have growing demand for food and a variety of other things. You know, people have known about this for a long period of time. Commodities, everybody in the investment landscape has an opinion, and normally a bullish opinion on commodities. And in the aftermath of a trend that has been, you know, a strong uptrend for the last 10 months, suddenly in September of last year, all commodities started to skyrocket for a variety of reasons. One is because, you know, the dollar has been falling, and the dollar and commodity prices tend to be inversely related and so forth. And a lot of investors found it basically a free bet. The Fed was going to give you 0% interest rates with no chance that the dollar was going to appreciate. You could speculate wildly, and things like sugar, which for most of my life was, you know, 10 cents a pound goes to 31 cents a pound. You know, we've reached a stage, and I think we reached a stage 2 weeks ago in particular. We've had a bit of a correction, but commodities are overpriced. Case closed. You can do whatever you want analytically to try to figure out how to justify them, but you need to use the same sort of metrics that you needed to use to say that Pets.com was going to be, you know, the savior of mankind. Fundamentally, I'm long-term.
Pets can't drive, remember.
Well, but you know, in the long term, I think the fundamentals are good for commodities. China and India and the emerging world are in a heavy industrialization phase of their economic development that requires a high intensity of commodities. But as Sandeep said, you know, people know that, and it's in the price. And what happened over the last 6 months is we were able to build up basically a speculative froth that encompassed all main commodities, whether sugar, cotton, silver. I mean, silver was ridiculous. You know, the price chart literally just went straight up, right? There was no, it's just speculative froth. Commodities may be a good long-term story, but the pricing is not right now for you to get in. You need to see the marketplace, you know, stabilize, get at least, if prices don't correct a lot, at least get some of the speculative froth out of the market before you can feel more comfortable about getting back in. Long term, yes, trends are good. In the investment business, it's how much you pay for an asset that determines what your return is, not whether the underlying demand trend is strong.
So to put this in context, to go along with the bullish secular trend in favor of commodities, they were also the beneficiary of hyper-cyclical stimulus in the form of a weak currency. I can't tell you whether an asset bubble has built up or it's in the process of bursting. The best way to identify the peak of a bubble or the trough of a burst bubble is literally 6 or 12 months after the fact, and to look up or look down and say, yeah, that was the peak, and that was the trough. But all the ingredients in the anatomy of a bubble seem to exist. You need access to cheap money, which there was plenty of. You need, indicative of speculation would be inordinate fund flows, whether you look at ETFs or commodities funds, you saw that in abundance.
Once again, investors chasing returns.
Chasing returns. And, I don't know, I can't count for you all the industrial applications for silver, but I can imagine that demand, the physical demand for silver, tripled in 2 years, like the price did. So something seems to be missing, and because we had this extended run, this may not be one of those, buy the first dip, because this is going to bounce right back. So just a word of caution.
Just a great, I mean, to interrupt, but just a great comment the other day was after the commodity correction that occurred 10 days ago or whatever, the last week, I read a statement by a guy who said, there's no justification for the commodity correction. There hasn't been any change in the fundamentals. When in point of fact, you could say there was no justification for the 50% rise that had occurred the prior 6 months because there'd been no change in the fundamentals. But of course, he's a bull and he can only see the last week. And you need to keep both perspectives in mind when you're looking at it.
Yeah, we've been fairly bullish on commodities for most of the last, we'll call it 7 years. Really, we started really encouraging allocations to commodities starting in 2004, 2005, and most of our clients have had those allocations for many years. But actually, in March of this year, we did say that commodities we felt were overvalued, and what we've basically suggested to people is not that they abandon the asset class, but that they pare it back so that it's towards the low end of their range if they have a policy portfolio. Let's say that the range is from 7 to 12% allocation to inflation-sensitive assets, which might include commodities. If they're not a taxable investor, it might include TIPS, inflation-protected treasury bonds, and it would also include natural resources equities. Okay, so that basket, if the target is 10% and the range is 7 to 12%, we would be towards the 7% end of that range. We don't necessarily think that you should abandon it. Even though, as we've said, the valuations are high, because we believe that inflation-sensitive assets do have an important role to play in an investor's portfolio. That said, implementation is a huge issue in commodities futures today, and it has been for the last 6 years, 7 years. And I mentioned the yield curve. Well, there's almost a yield curve equivalent in commodities, and it's called basically it's called the futures curve, and there's something called contango, and it's very complicated. But basically, when you invest in commodities futures, you don't want to actually take delivery of all those cows. So you sell the futures and then you buy the next contract, and the indexes do that for you. But the index costs you about 8% per year currently because the shape of that curve. So we think it's very important to either use an index that gets around that problem to the extent possible, or an active manager that can do that for you, and find places on that curve that are not as steep to do their rolling. It's a very complicated issue, but we would, long story short, we would just watch out for just a pure passive index approach to commodities.
Sean, one of the topics you mentioned and the other panelists have mentioned, last topic I'd like to ask about, then I'd like to invite the audience to ask some questions, inflation. It's come up several times. Obviously, the implications of the ultra-stimulative monetary policy are potentially inflationary. How big a concern in your minds is inflation over the intermediate term?
We're the wrong firm to ask. We don't actually try to predict interest rates or inflation. In our view, it's somewhat of a mug's game. And we don't think we have any real value to add. Other firms, other firms do, and they devote a lot of resources to it, but we don't. So inflation is always a concern for us, as is deflation, and so we build perpetual protection in our portfolios of our clients against inflationary events, short-term unanticipated spikes in inflation, as well as against long-term deflationary bouts. In the inflationary side of things, that tends to be, as I said, commodities, natural resources equities like energy equities or mining equities, and TIPS or inflation-linked bonds for people that for non-taxable investors, and the deflationary hedges tend to be things like treasury bonds. But those are kind of permanent parts of the portfolio, and we don't really try to say, well, we're worried about inflation, so we're going to skip the bonds, or we're worried about deflation, so we're going to skip the
Diversification
commodities.
is always important.
Yeah.
Sandeep and Peter, could you say a couple words about your views on inflation?
Given our firm's long-term perspective, we would echo all of those sentiments. Perhaps over a 6 or 12-month horizon, we would make the observation that there still is a fair amount of slack in the U.S. economy. So however you think of slack, it could be unemployment for the service sector part of our economy. If full employment is something like 5 or 6% unemployment, we are well above that. It's hard to see wage inflation becoming an issue with that type of slack. On the manufacturing side, it's capacity utilization that's also running below what you would associate with a steady state economy in equilibrium. So given these output gaps, while there is upward pressure on inflation, it perhaps may not be imminent on our shores. And keep in mind that there is a self-correcting mechanism in the economy. So rising inflation that has led to higher interest rates overseas, that global tightening, will have the effect of slowing global growth down, which in turn will reduce demand, which in turn will reduce the pressure on commodities. You're seeing it already, and a decline in commodity prices will have inflation subside. So those are some thoughts.
I guess the only really interesting thing then would be if I were to say I was really a strong inflationist. I'm not. I mean, I think the point is that in the emerging world, think of the world simply as the emerging world has strong economies, easy monetary policy, overly accommodative fiscal policy, and currencies that are too cheap. All of the ingredients necessary to have inflation, whether it's inflation of asset prices or inflation of goods and services prices. And it's important that you distinguish the two, because none of you will be mad if there's inflation of asset prices and you own the assets. And you know, that's an attribute that I think emerging markets can offer. In the United States or in the developed world, but let's particularly take the United States. I mean, again, there's a lot of fear about the 1970s. Yes, the Fed balance sheet, as Todd shows, is blown out. Fiscal situation is a mess and so forth. Number one, the Fed wanted to create a little bit of inflation because we were scared stiff about the prospect of deflation. And the only thing the Fed knows is nobody knows how to cure deflation. They think they have, 80-odd years of figuring out how to solve inflation. It's called raising rates, but they don't know what to do about deflation. But the real gist of it is that Americans don't have a lot of purchasing power and labor doesn't have a lot of pricing power. And in order to really get an inflationary mentality in the economy, it can't be everybody sitting around moaning about high gas prices or higher taxes or whatever. It's got to be about their ability to walk into their boss, knock on the door and say, I want a 10% pay rise, and have the boss say, I'll give you 8. That's not happening. It doesn't look to me like that's going to happen anytime in the near future. In fact, I think an awful lot, an increasing number of Americans are scared stiff that their standard of living is going to be declining for a prolonged period of time because they're competing against people earning a lot less money in the rest of the world. So, I think, yes, you need to be sensitive about it. In your portfolios, you need some protection against it, but it's not, there's a lot of things that keep me up at night. It's not one of the principal ones right now.
Thanks very much. I'd like to invite you to ask questions. We have people with microphones who can come and bring the microphone to you. Are questions from the audience? Yes.
Peter, you referred to not kicking the patient in the teeth with a steel-toed boot in Greece. You also referred to in your earlier comments about the United States purchasing power beating the world out of a worldwide recession. Obviously, the United States purchasing power has eroded and will continue to erode. You said that yourself. 71% of GDP being consumer spending is not sustainable, and the legs that held that stool up are gone. Cheap debt, cheap credit, and major asset holdings being, with the single-family residences and condos going down in value and continuing to go down. What is going to replace consumption? Is it the green economy or what is going to replace consumption to lead us out
Right. Well,
of this mess.
okay.
And maybe be instructive to other countries to find a way to lead them out of what they're suffering.
Okay, so the question is what, the U.S. has been a consumer-led society. We're instrumental in the cycle, and yet we know that we can't carry on with the habits and behaviors that we have. And I guess the way I would respond to this is that when you look at the global economy, the ultimate salvation that we all think is that if the Indians and the Brazilians and the Chinese and consumers in the emerging world can start to carry the weight or take the baton and run with it and provide consumer spending that Americans can take advantage of and we can export to and so forth, then the world will be a better place and we'll all be fine. And that's absolutely true. If we look out 10 to 20 years, if you believe there's some group of global policymakers pulling the strings on things, that's what we're all trying to achieve, right? The problem is that when you're in a cycle, Americans tend to be very interest rate sensitive, and historically, when we stopped spending, after a little while, we deferred purchases of televisions or refrigerators or whatever, but the Fed could step in and bribe us to buy stuff, right? And it was crucial because the whole global economy, every single economy in the world except ours, is built on an export-led profile. And it was built on, you make stuff, you sell it to Americans, and as long as Americans were optimistic and would take the bribe when the Fed put it in, the world, we would get the world out of an economic recession. You had to take on debt. You had to be optimistic. You had to be willing to take on debt to take the bribe and spend. And once the spending process got going, it embraced everyone else. The challenge for an investor, for the global economy, and everybody is we all know where we want to go, but we're not ready to get there yet. China's not ready to lead. Europe's not ready to lead. There isn't anybody to take the place of the American consumer. So what we're really saying is, okay, you've got to change your habits. Just don't change them now, right? And it's just like the fiscal situation. We all know we need to change, but now doesn't seem like the best time to do it. And as an economist, when you're looking down, you need help getting out of the mess. The challenge for us with our, this is a paid political statement, but when we get a recovery, if it continues, we must fix ourselves during the recovery in the United States, and we must fix the global economy. We have a hugely imbalanced global economy, overly dependent on American final demand, overly dependent on Chinese excess savings. China's got an investment to GDP ratio of 50%, right? Massive capital misallocation. The global economy is completely imbalanced. Nobody wants to take the first move necessary to change it because it inevitably involves some hardship. So
we're doubled down, essentially.
We are doubled down. If we don't have a long economic recovery process, it's going to be more challenging for us. But we still have Americans. There's more to the U.S. than just consumer spending and debt. I mean, we are a productive nation, and I think we can get ourselves out of this. But at the end of the day, when you get the opportunity, you must take advantage of it. And so far, we're not demonstrating it, and so far, China's not demonstrating fully. They have a commitment, a statement, but they have to put their words into action before we can be more comfortable that we're moving in the right direction.
Other questions? Yes.
Notwithstanding the mess in Europe, but considering our apparent inability to get our own house in order, I'd be curious to know from each of you your assessment as to the likelihood that within the next year or two, the dollar may actually end up in free fall.
The dollar has declined significantly. Oh, the question of each of the panelists is how likely is it that in 12 months' time the dollar is in a complete free fall? Again, with the qualification that it is hazardous to kind of engage in these short-term speculations, I would offer the following observation, that the current weakness in the dollar, keep in mind, it stems from an asynchronous timing of monetary policy responses as we stand right now. The rest of the world has tightened. In fact, we can almost draw a monotonic relationship as you move from east to west. So Europe, somewhere in between, joined the queue. Asia was there first. And so the current weakness, which is extremely painful, is influenced by the fact that we are the only economy or the only central bank with a loose monetary policy. Everybody else is raising rates. When that gets into some type of equilibrium, that will provide a floor to the US dollar. And so all of these inflationary pressures, as they work their way through to the US, and gas is at $4 already, and oil was at 110, and the impact will be felt in the US on a lagged basis. Whenever the Fed steps up to the plate to join the rest of the party, or not the party, but the party poopers, I guess, that might provide a floor to the dollar and perhaps mitigate or avoid the scenario that you speculate.
Yeah, I mean, yeah, I would agree with Sandeep. The dollar is quite reasonably valued, and undervalued against many currencies, particularly the emerging currencies, many of which are managed, but as well, if you look at, versus the yen or versus the pound sterling versus the euro, the dollar is already represents pretty good value. That said, I mean, currencies can move. If you think about valuation, currencies can make large arcs around that central area. So, could the dollar continue to depreciate significantly? Absolutely, but I would say that it's at least as likely that it could appreciate, over the medium term.
I'd like to make the bold statement that there's a 0% chance that the dollar will be in free fall over the course of the next 12 months, because the things that would get us to free fall would be cataclysmic for the U.S. economy, and the U.S. economy and the financial system are too important to the global economy, and it would have a devastating impact on the global economy. And as we saw during the downturn in 2008, the response of the U.S. is falling apart and Lehman's going bust was the dollar appreciated quite dramatically, because the Treasury market has been and would not be under those circumstances a safe haven. But the thing is simply that it's in everybody's interest. The Chinese interest, it's in the Chinese interest. It's in the Saudis' interest. It's in Germany's interest. It's in everybody's interest to see an orderly foreign exchange market, because the impact of a disorderly foreign exchange market and free fall in the dollar would be problematic. Now, anything can happen, but the depreciation of the dollar over a multi-year period is something everybody can live with. A precipitous decline would precipitate aggressive action on the part of the world's central banks to try to provide stability, because a free fall dollar, it would be devastating to the global economy. Stuff happens. But again, that's not, I wouldn't spend a lot of time worrying about that one over the next year.
I think we have time for one more question. Yes.
So Peter, you made the comment that you can't tighten your belts to recovery. So where do any of you see innovation, either by market sector or by geography, that will stimulate growth and stimulate investment?
Am I taking that one first?
Go ahead.
Well, first off, I think there's a natural reaction of people to whenever you're in a difficult economic time, it's very hard to figure out which sector, we are always doing this, which sector is going to be the one that drives us out of this, because I can identify the 6 sectors that won't. But normally what happens is because we can't identify the stuff that hasn't been invented yet, or we don't fully understand this. I'm a believer, what do I know about technology? Nothing. I'm a believer that the technologies that we are already have in the economy and we're well aware of have massive further exploitation potential that can drive productivity and enhance our prosperity and well-being in the future. We can put productivity into the government sector, into the medical sector. I mean, we have a massive excess allocation of resources to the medical sector that productivity improvements could help over the course of time. But I think the crucial thing that that in the United States is if we demonstrate a willingness to at least gradually address the structural problems that we face, we have a natural tendency. It's an economy that's open, it is innovative. Our natural tendency is to innovate and grow. If there are obstacles that can prevent us, if we start to address some of the obstacles, I think the natural tendency will be to take advantage of technologies that we can already see and feel all around us.
America has tended to innovate, the rest of the world tends to imitate. So again, I can't pinpoint exactly where this next killer application or the big home run investment opportunity lies, but I am optimistic that, in fact, let me end on a bullish and constructive note for the US economy, where despite the 71% contribution from consumption, we are about the only country in the developed markets where if potential GDP or natural tendency for economic growth comes from growth in the labor force and productivity gains of the existing labor force, which pertains to your question on innovation, that we'll be fine on both counts because our demographics are not particularly stellar, but we have always been open to immigrants, and I sit here in front of you as an example of that tendency. So motivated by perhaps hopefully an open immigration policy and continued productivity gains, we might be surprised with how resilient the U.S. economy does turn out to be.
This may not be a direct answer to your question, honestly, but what I'd like to do is just kind of take it from the investment point of view. And from the investment point of view, we don't have to have dramatic increases in sales and revenues in the U.S. for investors in U.S. companies to do pretty well. And in fact, if you look at the expectations, going forward over the next couple of years, the expectations of earnings growth for U.S. companies, for example, Peter's slide showed the high ROE, return on equity, and the high profitability. The expectations are that that's going to come from profit margins more than really from increased sales. So it is possible that we could have an anemic economy, but that as shareholders of the world's corporations, you could still see some benefits. Now, on the flip side of that is that profit margins are already somewhat elevated relative to their historic norms. So, is that going to be sustainable? That is one of our concerns, certainly over the next 18 months, is the margin side of things.
I'd like to thank you all again for coming out tonight. I hope you've enjoyed the discussion. I'd invite you to join us down here. We have coffee and dessert set up behind the screen, and you can mingle with the panelists and ask any additional questions that you may have. I'd like to particularly thank Betsy Huntley from Choate's marketing group, as well as Sonia Mangino and Courtney Molyneux, who really were instrumental in organizing this whole evening. So thanks to them, and thanks again to our panelists.